Right, welcome back to all our listeners. My name is Ernst Knacke and I head up the research function here at Shard Capital. This week it'll be our first video podcast, so we're super excited. And we're going to talk a little bit about asset allocation, macro trends that we believe will play out over the next decade, and how to diversify and future-proof your portfolio. Now, I'm delighted to be joined by Andrew Beer. He is founder and managing partner at Dynamic Beta Investments, and also the manager of the Dynamic Beta Managed Future Strategy. Welcome, Andrew.
Thank you so much. Great to be here.
Right. So first off, I think everyone does it, and it seems appropriate to do it here as well. I think it'd be good if you can give us a background to yourself, and specifically to Dynamic Beta Investments and what you do there.
Sure. So very briefly, I've been in the hedge fund industry for almost 30 years. I went into it pretty much by accident in 1994 when I got recruited at my second year of business school to go work for a hedge fund manager, not knowing what a hedge fund was. But since then, I've been not just running portfolios, but also involved in starting several different hedge fund businesses. And what I've done over the past 15 years and what we do at DBI is basically try to tackle the question for, not for institutions and big family offices, but for everybody else. If you only invest through UCITS funds, if you care about liquidity, if you care about fees, how do you get the diversification benefits of hedge funds? And, so specifically for today, we back in 2015, my partner and I were building a portfolio and we were trying to find a way to hedge equity and bond risk that we had in other parts of the portfolio. And we did a deep dive on managed futures, and it really launched our initiative in the space. And so now we manage over $1 billion in managed futures-based strategies, and but with a very, very different approach, which I think you'll find interesting. It's going to line up, I think, very much with your view on the markets and the world over the next 10 or 20 years.
Yeah, and it's fascinating that the managed futures product you provide is no different really to any other managed futures product, where when you think of hedge fund replication more generally, there is a certain thought process around replicating products through something that is not exactly the same, where with managed futures it is really groundbreaking, right? It's it's revolutionary.
I think a lot of hedge funds, when you've been inside the hedge fund industry, it's a lot less mysterious than it sounds on the outside. And for certain hedge fund strategies, at any given point in time, a handful of big trades are going to make all the difference. Yeah. And if you think about even people talk subprime, this incredible trade of the decade, no one talks about, well, he had a tiny position in subprime, but he happened to pick the very best tranches to short. The guys who got famous were the guys who went all in. So what we've really tried to do as a business is basically say, how do you identify those trades? And are they worth identifying, and kind of asking those basic questions. But then I think really starting from your side of the table, from the position of an allocator, what is it that you're really looking for in these strategies? What do you mean by diversification? What do you mean by some of these? What should the ultimate goals of your fund selection and investment approach be? And so we came at all of those from a very different angle, which fortunately today I think people realize. Yeah. Again, if you're starting with an asset allocation mindset, I think our approach ends up working quite well.
No, definitely. So with that, I'm going to jump into a few slides I've prepared. As I mentioned, the main discussion today is, I guess, revolves a little bit around how and why investors should think about their asset allocation for the decade ahead, and specifically the role of managed futures that play in the portfolio. Now, before I go on, I would like to remind the audience that this is not investment advice, and if you would like any further information, please get in touch with either ourselves or with your financial advisor. Right, so over to the slide. So on slide 1, I highlight what I term the demographic time bomb, and this shows the old age dependency ratio here on the left. And what is interesting is that in 5 years' time, the OECD countries will, over a third of their population will be older people, effectively, people that depend on the labor force. There's a younger people dependency ratio, those under 16, of course, they're in decline. But the problem is that older people cost more, right? Whilst younger people, you have that expectancy of at some point they're going to join the labor force, which is of course not the same for older people. Now, one of the other problems that results, especially if you think of the welfare state that we live in, is the explosion of debt, specifically liabilities, to this older cohort. And expectations from the World Economic Forum is that the global pension liability is going to reach $400 trillion over the next 30 years. And that's 4 times the current global GDP. So it's a significant liability. And there's ways you can fund this. You can increase taxes through economic growth. You can increase taxes by increasing the tax rate for individuals or for corporates. And I'm not sure that's going to happen. I believe the most likely outcome is people are going to print money. We'll see if that turns out to be the case. But history would suggest that is what's going to happen. So this shows us federal debt over the last 50 or 60 years, and I guess the monetary access that governments have just by switching on the printers is something that they cannot ignore, and that will most likely happen again in the future.
I think what's interesting about both those charts is it's the easy solution, right? It's in the short term, it's always the easiest thing to do, and I think we have back to your point about it. There's a huge problem right now is how do you get people to stop spending money, whether it's governments or individuals, in a period where inflation's gone up, and you're right, the default is. And we had a decade where money printing had no adverse consequences.
Yeah.
We didn't crowd out the private sector. Apparently, we didn't see bond vigilantes, driving treasury yields up. And so you've had this hangoverless for a long period of time. You had this kind of hangoverless party, and I think it'll be really interesting to see how it plays out, because logic suggests that at some point the party is going to end.
I completely agree, Andrew. So here I have a chart of 120 years of US inflation. And what is interesting is you can see pre-1950, inflation was relatively volatile. There was periods when we had significant deflation and significant inflation. And then post-1950, we had the baby boomers entering the workforce, creating significant demand. And then really since the 80s, you had this central bank intervention and money printing mindset or quantitative easing mindset that have resulted in inflation, very nicely managed between kind of 0 and 5%. That, of course, came to an end over the last 18 months or so as a result, I think, of the fiscal irresponsibility of central banks and governments. Right now, I think we're at a point in the cycle where inflation is going to go down. However, at some point it might shoot up again. If I think of the inflationary consequences of money printing, if you think of the inflationary consequences of this transition to net zero and the transition away of just-in-time supply chains to just-in-case supply chains, that will most likely be very inflationary and deflationary over time. The likelihood is that we're in a period much more like the pre-1950s as opposed to the last 2 decades. I'm going to jump into this slide quickly now. Here, this highlights the correlation between bonds and equities, and I think this is the biggest kind of negative. You think of a 60-40. If you have the 60-40 mindset in your head and an undiversified kind of bond equity portfolio, is that history have showed that during periods of high and rising inflation, bonds and does not really provide that decorrelated outcome that one would expect. And we saw that again last year. Inflation went up, and all of a sudden people realized, oh my goodness, this is not good for rates, not good for credit spreads, and bonds sold off. And this is really why people should consider their asset allocation framework in the current environment.
Well, this chart is a nightmare for large parts of the wealth management industry. I mean, it's because this was the cornerstone of how portfolios were diversified in the first place. And I think lining up with this, we're seeing more and more research where when nominal rates are above about 4%, you tend to get positive correlations. And I'm not sure about the time frame here, but if you just look at last year, obviously the correlation was positive. And again, correlation is kind of a weird statistic because sometimes even during the 2010s, I would argue that stocks and bonds were positively correlated because you had an underlying force of central banks, dropping interest rates, which was driving up both stocks and bonds, obviously. But you don't see it in the day-to-day data. So correlation kind of masks when you have some underlying cause. And if you look at January, people start thinking inflation's coming back down, and both trashy stocks go up as well as bonds, and so it's very hard to make an argument that you're hedged at this point. So
exactly. This is from GMO. Anyone in the audience can register on their website and go and find this. But this is a 7-year expected return forecast for various asset classes. And I think what comes through here is that there's not a lot of, at least relative to history, in equities and bonds. Generally, the expectation is for returns lower than the average, and diversification should be considered. The other factor that people should consider within a portfolio context is when you print money, you devalue the currency. And when your currency is devalued, of course, there's other assets that perform exceptionally well that retain or store the value, such as gold. Now, I don't know if this is going to happen over the next 20 years, but here is just an example of what can happen if governments go out and print money. Within that context, I've created a table kind of to show investors 5 asset classes and kind of one specific characteristics I want to target here within these 5 asset classes is that maximum drawdown. So this is the same period that I showed in the chart from the end of 2001 up until the end of January. And you can see that from a drawdown perspective, the CTA basket, which is a basket of managed futures strategies that Andrew will explain a little bit later, has by far the best kind of drawdown risk in here. So the benefits of preserving capital during a drawdown is of course very attractive. At the same time, here I showed the green line, which is the managed futures index, relative to equities and bonds, and you can see when equities significantly fall during a recession or an adverse shock, the green line tends to hold up or go up even. So this brings me to the second part, which is the diversification benefits. And here we can see that the correlation between managed futures and any other asset class really is low to negligible. I don't know, Andrew, would you say that is a fair statement?
Yeah, and it's so like a lot of things, correlations go up and down. So one I found most interesting in these was actually the Bloomberg Commodity Index. Because it's over the past 20 years, it's had positive correlation to equities. Commodities, the thing that really drove the growth of investor exposure to commodities in the 2000s was a paper that was written in the late 1990s, where for the first time somebody had taken the commodity rolls and basically tried to calculate the return of just having a passive investment in the commodity space. And the conclusion was that if you was basically that commodities had equity-like returns, but zero correlation to equities. And that worked for a little while, but then since then, actually commodities, like a lot of other things, REITs, for instance, have very high correlations to equities. So I think this, on the managed future side, what you do see is over long periods of time, because as we'll talk about, these guys really do march to the beat of their own drum. They do have zero correlation, but like any other asset, sometimes you'll be more positively or negatively correlated. But I think from your framework of talking about this in very long periods of time, and the ultimate goal of your 45, what's the smoothest way to get from here to retiring happy at age 65, you have to think in a long-term perspective.
Exactly.
And that's where you have to think about really what's driving the returns of the underlying strategies. And managed futures is very different. and
Yeah.
for reasons we'll describe.
Yeah. So one other, and this is the final kind of, I guess, benefit of thinking about diversification is the crash risk. And here I show 5 specific events over the last 20 years or 20 plus years. One being the dot-com bubble, which was really a growth equity bubble. As long as you had anything else than growth equities, you would have come out through that period quite well. But then there's other periods like the global financial crisis, the shale crash, or last year's financial asset bubble, as I term it, where there's often not a lot of assets that protect you during these significant disruptions. And the one that does is the CTA. So this clearly highlights the benefits of including a managed futures allocation to your product. So when we construct a portfolio, I think what is crucial to investors and asset allocators is one, to understand the return profile and understand the liquidity profile of your investments. The second would be to manage those drawdown risks. Don't diversify all your returns away, but diversify away the risk. It's 2 very different concepts. People very often just add bonds because they think they're going to diversify away some of the risk, but there's periods when you actually just diversify away some of the returns. And then understand the value of your asset. I think it's crucial to understand where we are in these longer term cycles, and what is the upside potential relative to the downside risk of your portfolio. Here I have some statistics around the expected returns, volatility, and the risk return ratio of breaking those down, and it clearly highlights the benefits from a drawdown specific characteristics, but also from your risk return ratio, which is effectively your annualized return divided by the annualized volatility or the annualized risk. And as soon as you add some of these other assets, you clearly get a much better outcome in those portfolios. And in this slide, I highlight those. With the green and the yellow line are the diversified basket of assets. And you can see relative to a traditional 60-40 portfolio. And if you take a step back, this has been a fantastic period for 60-40, right? With the exception of last year. And I don't think the future is going to be this attractive. So even with in a good time, there is reasons why adding diversification through managed futures or otherwise adds value. So at this point, I think, Andrew, I'm going to hand over to you to discuss more a little bit about managed futures specifically, what it is, how it behaves over time, and the role it plays within a portfolio.
Sure. So look, first of all, thank you. The slides are incredibly interesting, and part of what I find so fascinating about it is from your perspective as an asset allocator, right? When you talk about those 4 different buckets, gold is easy, right? You can buy gold through futures contracts. You can buy it through ETFs. You can buy it through all sorts of different ways. Global equities and bonds. There are a million different easy ways if you want index-like exposure to that. Managed futures is hard to get that kind of exposure, and I'm going to talk a little bit about what the space is, and then, but that's been. I think there's no other strategy that I found where the potential on paper is so favorable, but the experience that people have invested in it has been so difficult, and that's, I think, because of certain landmines that we'll talk about. But first of all, what is managed futures? So managed futures, and it's people sometimes refer to it as CTAs. That was an old term in the US, kind of a regulatory term of art. But basically, in very broad brush strokes, it's an investment strategy that hunts for trends across commodities, rates, currencies, and equity markets. So simplistically, if gold is going up, as you say, they may be long gold at that time. If gold is going through a very tough period, they might be short at that time. They don't always get it right, obviously, but the idea is that there are these market waves that are going up and down. Sometimes the seas are choppy and they're getting bounced around. Sometimes you get big tsunamis like you have last year. And, so particularly when you have one of these big regime shifts that often drives these brutal drawdowns in traditional assets, they tend to do the best. So it's a strategy that's been around for 50 years. There's a huge amount of misinformation about the strategy, which I'm trying to correct. But basically, it was at one point, it was only available in hedge funds and managed accounts. Now you've got UCITS funds, mutual funds, et cetera. So it's becoming available more broadly. The key terms are, so managed just simply means they're going to change what they do over time. Futures is because if you want to bet on gold going up, the most efficient way to do it is by buying a gold futures contract. And if you want to bet it's going to go down, you sell a futures contract. These are quantitatively based strategies. So humans are building these models, but the models themselves determine the portfolios. And back on this idea of market waves, it's a kind of a pithier way of saying that they're betting on trends. They think that, and in theory, if you believe in perfectly efficient markets, then you probably shouldn't be in this business to begin with. But in theory, trends shouldn't be a way to make money. It turns out they are. And because, as humans, we have biases and constraints and other things that where we leave money on the table. But the really important thing, back to this asset allocation argument, is there is no easy way to just say, I want managed futures and put it in my portfolio. That managed futures, when we talk about it, we talk about the long-term data, we're always talking about indices of hedge funds. It's not like the S&P 500 where it's easy to go out and buy the 500 stocks if I want to, but you're talking about hedge funds that themselves are not easy to invest in. So getting from that theory of managed futures to practice and how to build a durable investment strategy is really hard. And I'll talk about the issues. So the key thing is and kind of following your points is, why do you want it in your portfolio in the first place? And the strategy we think has more diversification bang for the buck relative to 60-40 portfolios than private equity, which is highly correlated to equities. Private credit's highly correlated to bonds. REITs correlated to both. So over, we're talking about a 22-year period where you have good data. It's done 75% of the returns of stocks, 120% of the returns of bonds. And that's back to your point where you don't want to diversify yourself back to cash-like returns. You've got to find ways to actually accumulate and grow assets over time. And then the second is it does have near zero correlation to stocks and bonds. Again, it does go up or down. And then also following on your point, it's hit the trifecta of gains, right? When you look at your chart on different market crisis periods, very few things have done well in all three: the dot-com crisis, the GFC, and last year. And so, when you stop here, if you're an asset allocator, it's sort of obvious this should be part of your portfolio. And next, I'll flip through the other slides quickly because I think it's so diversification means different things for different people. And I think one of the things that I've heard from the wealth management community is that some of the statistics that you're talking about are 10 or 20-year statistics, right? What does GMO think are going to be the returns of equities versus bonds over 10 years? But there's also a much more shorter-term human element to dealing with clients. That it's our job to keep people calm during difficult periods. And so this idea of the trifecta of gains or doing well during the worst periods when it feels like the correlation of one goes to zero, we call it this beacon of green in a sea of red. And what this is a chart on the left, you see the SocGen CTA index, hedge fund index. So the average hedge fund in the space was up 20% last year. But then every equity asset category was down. Every fixed income category was down, including tips, which surprised a lot of people. Commodities were up. But as you see from your statistics, commodities have had a 70% drawdown and they got killed during the GFC. And REITs are down 27%. So I think, often advisors, what they're really playing for in a strategy like this, and this is kind of a simplistic way of talking about fund selection, is what they really want is something where they can, even if it's a 2% allocation, but you can point to this thing in a client's portfolio at the right time. But then, we say this a little bit tongue in cheek, like the goal of fund selection with diversifiers is to have something you can talk about when you want to talk about it, but never get dragged into a conversation about it when you want to talk about other things.
That's so true. And, I think for me on my side or asset allocators generally, it's about not losing the client at the worst time. Right? And no one is going to produce positive returns forever. But when it's a bad market environment, if you have some outliers, some of these green dots, that you have on this chart, it just adds so much value to have that conversation with the client and then reallocate the assets more appropriately for the future.
Right. I think the advisor community is always, they're confronted with a vanguard world where people say, advice is worthless.
Yeah.
Stock selection is worthless. Everything's worthless. The only thing you should care about is buying a 60-40 portfolio with low fees, except for the fact that by the end of that was great advice for the 2010s. It was terrible advice in 2022.
Yeah.
Why? Because you had a 60-40 portfolio that had, in the US, you had the S&P 500, which was a massive tech stock bet at that point, which was dependent upon low rates. And you had corporate credit that was yielding 1.5% over here, which is also a bet on low rates. So Vanguard and others pushed you into a single bet that rates would stay low forever. And so I think I think it's a lot of those human dynamics of trying to break people away from that very, very powerful ethos that you should just kind of throw it in a 60-40 portfolio and go home. So these kinds of things. So, and by the way, this is so, when I talk about this as a strategy, people feel like it should be really risky, right? It's leveraged, long, short, derivatives based, quant, black boxes, right? It's terrifying for an allocator, but over 22 years, the max drawdown is 14% on a monthly basis, or 17, 18, 19% if you look at it on a daily basis. And it's much less risky than much less risky than stocks, arguably less risky than bonds today. And volatility kind of between the two of them. And so part of my job is to sort of like get people away from this fear of the space. But I think there are two things that I tell people about this space. One is that it's a strategy, because it's quantitatively based, it doesn't hold on to positions with a white knuckle grip. They can lose money, but once a trade starts to go against them, this is not Kathy Wood, whose life and everything is built into the fact that disruptive tech stocks are gonna, they may be down 90%, but that's even a better buying opportunity. That doesn't exist in this space. And so you can get these, succession of paper cuts where you can lose 10% or over some period of time, but you don't get those catastrophic drawdowns you get with stable assets.
I agree that the risk management is generally speaking, is a key part of selecting a good CTA manager. But from the strategy as a whole, the category as a whole, tend to provide, that protection, and that it starts to go down, but the dynamic will change.
Yeah, and look, and no strategy is perfect, and what we said about this one is the reason they tend to do better in longer crises is because, when the waves are going like this and it starts to go down, so many of us are trained and wired to think about buying the dip.
Yeah.
If you're a stock picker and you bought a stock at 100, now it's trading at 70 because the economic world is changing, 90% of stock pickers that I know are thinking about whether to buy it.
Yeah.
Whether they should be averaging down.
The American alpha male, that is the characteristic of the hedge fund manager, right?
That's your opportunity, right? You want to be, you don't want to be, the last thing you want to be is the guy who panics.
Yeah.
Right. You want to be a steel-spined person who is buying all the way down. And it's very, very compelling. But every now and then, look at what's happened to some of these, tech-focused hedge funds, or it's just, it's really bad in 1 year out of 10. And the thing about managed futures funds is they don't care. They don't write investor letters to people telling them what they think, that they think inflation is transitory and they don't want to go back on it, or that rates are going to stay low forever. Once the world starts to change, they just pivot. So we say it's sort of a crapshoot as to whether they'll make money in the first month of a crisis, but in months 2 through 6 is when they tend to shine. And that happened last year. So in theory, it should be this great asset allocation. This problem number one is it wasn't built for the wealth management community. And by that, I mean, when you say, I want gold, right? My guess is you're not going to go around and, spend all of your time trying to figure out whether you want to buy it from this mine or that mine. And, I mean, all these, it's gold, right? It should be easy and straightforward. Managed futures, because it started as hedge funds, and every fund is different. If I build a fund and you build a fund, by the time we get through specifying all of the different, turning dials on our models in all sorts of different ways, we end up with very different outcomes. So this is what we use to show it. That green line in the middle is the asset class, right? It's the 20 largest hedge funds. Those gray lines are the 20 hedge funds back when we started doing this in the US in 2016, and they're all over the place. One guy does well, and then people throw money at him, then he does much worse than people expect, and then a guy who's doing terribly comes up and rebounds. So it's very, very, so the first mistake that people make is they say, I want those asset class returns, and then they pick a single fund to fill the bucket. That is allocator suicide, because at some point it is highly likely, not certain, but it is highly likely at some point over the next 2 or 3 years, you're going to have a problem child allocation on your hand. And the problem child allocation is when you've got a 5% allocation. Back to this point about you don't want to be dragged into conversations about it. And so now let's say the SocGen CTA index has done 3% over a 3-year period of time, but your guy's down 15.
Yeah.
How do you explain that?
Yeah.
And as an allocator, you've got a business to run, you've got clients to manage, and all of a sudden it calls into question, you're supposed to be good at picking these guys.
Yeah.
But nobody on planet Earth has figured out how to tell which one of these guys is going to do well.
And it's so difficult with managed futures because it is not a shall I say a path dependent profile. When it's down, it's not necessarily going to rebound up. That is
there's no intrinsic value. There's no
Exactly.
don't get out of value stocks now because it's at 4 times EBITDA. You've at 25%. I mean, there's none of that. And so a lot of people have tried to time the space.
Yeah.
Because you do get these lower return periods and then it spikes. I've literally never found anybody who has a way of doing that reliably.
Yes.
Every now and then, 1 out of 100 conversations, I'll have a guy who got it right, but almost invariably, it's people are getting out at the wrong time, and then you're not there, because the whole point is they make money when the unexpected happens.
Yes.
And if you know when the unexpected happens, trust me, there are much better ways to make money than trying to invest in a managed futures fund. So, and call me, please tell me what's going to happen. So landmine number 2 is that, hedge fund fees and expenses are high, right? When you get through trading costs and management fees and incentive fees, you can be up at around 5%. It's probably not quite so bad in UCITS space. But by the time you do some of these strategies in UCITS funds, you lose some of the good stuff off the top. So you probably end up at roughly the same place, or maybe even a little bit worse. But the point is that, so why should you care, right? Because most people say, honestly, like if you had a guy who was up 50% last year and you paid him 20% to make that 50%, no one cares because he was up 50%. The problem is that the strategy, when you are in those choppier seas and guys aren't making a lot of money, they're making $2 here, giving back 1 here, giving back 50 cents here, et cetera. Then when you have a high fee structure, it weighs on the strategy.
Yeah.
And so when we talk about this long winter from 2016 to the early parts of 2021, where the strategy basically had a 10% drawdown and didn't make money for people. But again, we're talking about hedge funds and 500 basis points of fees and expenses. So what it meant was 100% of your alpha got paid away. These guys actually did, because remember, cash was earning roughly 0. So these guys were earning 5 over cash, but between trading costs and everything else, just none of it was making back to clients. Yeah. And clients justifiably get annoyed when it feels like everybody's making money but them. And then what happens is you're not there for the moment when it comes bounding back.
I imagine if you're a sovereign wealth fund, you can kind of get the fees down, but not the individual, not the wealth fund. Well, that's business.
Right, and that's so we actually coined it. It's funny, we coined a term in so even back to the 1990s, like family offices who invested in hedge funds, who are like seed stage investors in hedge funds. They never paid full fees, right? In hedge funds, it's always been about full fees are for the next guy.
Yeah.
And what happened in the 2010s was that, you're right, a lot of sovereign wealth funds and big investors basically said, guys, we're not paying you 1 in 20 for this. We can, because we can look at all those 20 guys in the space, and we don't think we should be paying you 800 basis points last year after having not made money for 5 years, or so they drove down fees for them. And we coined this term back in 2011, that basically in hedge funds, fee reduction can be the greatest form of alpha, because it just means every dollar you can bring down fees, just more of it comes back to you.
Yeah.
And at last, about 18 months ago, the funny thing, I was watching a pension plan conference, and one of the guys at one of the institutional investors said, well, part of the way that we manage our hedge fund portfolio is we believe fee reduction is the purest form of alpha. So I was like, I almost fell off my chair, because I had said it as kind of like a possibly a critique of the way most people were investing in this space. So landmine number one is you got to figure out how to resolve single manager risk. And again, if that big sovereign wealth fund is going to pick 6 of those guys, and they're going to be able to put together a car from guys who have everyone has different strategies and different nuances to what they do. And then you got to figure out a way to deal with fees and expenses. And if you can do that, remarkably, you don't just get the return statistics that you showed, right? Because all the return statistics you showed are net of all of these fees and expenses.
Yeah.
So you can actually do even better than that, and you can make this strategy on its surface even better. So that's essentially what we set out to try to do in 2015.
And two of the key, I guess, headwinds being managed alongside, an index plus outcome, which is rare.
Well, so I mean, imagine if you could invest in gold plus 200 basis points.
Exactly.
Right. It's S&P plus 200 basis points. It throws off all of your asset allocation calculations.
Yes.
So as advisors, and I just wrote a white paper on this, if anybody's interested, I'll share it, but it was geared toward the US advisor community. So it's a little bit more US centric. But basically, look, as a wealth manager, you've got 4 ways to tackle this. Once you make the decision you want managed futures in your portfolio, first option is you can buy a single fund. Okay. I think it's too risky, but there are a lot of reasons why you might want to do it. There are incredible brand name funds out there who do this. You can, Man AHL has a fund, Alpha Simplex, remarkable firm, has a fund, AQR. So you can get exposure through a single manager. My view is that for a wealth manager, that's too risky, because you don't want the problem child, the 5% allocation, to be 30% of your time. You can go 2 to 4 single managers. And for larger wealth managers who have the resources to do it, yes, but again, if you got a 5% or an 8% allocation and you've got 3 guys in it, it's 3 times the work. Even if 2 guys are doing well, but 1 guy's doing terribly. I mean, one of the members of the SocGen CT index was down 35% last year. Like you can get, when these things underperform, they can really underperform on the single manager side. You get this cluttered bucket with a client portfolio where you've now got to explain these 3 different funds. So it's a lot better, I think, than the single manager approach. The multi-manager approach, I think, if I had to invest in I would go down the multi-manager route, just because you've got, now again, in the UCITS world, I'm actually not aware of a good single multi-manager product out there. There are some in the US, but you would know better than me. And then what we did is basically we pioneered this idea of replication. And in the US, it's ETF only. We've just launched a UCITS clone of what we do in the US. But here the idea was what do you want, as you say, as an asset allocator? You want that index return, that index you can't otherwise invest in. And so we basically set out to say, can we identify the big trades in that index, copy them in a low cost way, put them in a daily liquid UCITS fund or ETF, and that's called replication. And the idea, yeah.
No, I think, if I can add, the replication strategy is, if you think of managed futures and how they manage through the quantitative model, it sounds simplistic in many ways, but on the other side, it's quite difficult to explain a single strategy to an individual, especially if you go 1 level down. where your product is doing exactly the same, just with better diversification. It tracks, the index, and you effectively get that index plus the fees, which is a bit of free alpha.
I mean, we went down this approach because we thought it was the best way to get to that answer. Obviously and the thing is, you can only do replication if you come at it from a different direction. As you will, if you interview, if you do these with like 3 guys in the managed future space, you will see that I talk about the space very differently. For me, it was a tool. It was something to add to a portfolio to reach a particular outcome. And I wanted to there's this this talk that Steve Jobs was giving in 1998 about Apple products, and Apple products are being criticized for being too simple, right? Replication is, some people feel like it's very simple, and he was saying, the criticisms are right. We are simple, but you can build products in 2 different ways. You can get engineers in the room, and they're going to build a product that they want with all the features that they want, or you can sit down with the customers and figure out what's going to make the biggest impact on their lives. And in this case, we felt the biggest impact would be something that was predictably index or benchmark plus. We didn't know how the benchmark would do over any given period of time, but if we could do it in a low cost, liquid way and do a couple 100 basis points better by squeezing out fees and expenses. And he said, he said, so we try to figure out what the customers want, then we get the engineers in the room. And we were the customers and the engineers. In this case. And so we built what we wanted. And unfortunately today, I think that's the message is resonating with people. Do you
think you have managed to democratize the managed future space in a certain sense?
Well, we're certainly trying to. I think I just wrote this white paper, and one of the things I realized in doing this white paper, and it was designed to be much more practical, kind of these kinds of issues that people confront. There's so much misinformation, right? So democratization arguably is a bad word, right? In that often fund managers have a product, they take it, they put it into a UCITS fund or a mutual fund. It happens to have done well as a hedge fund or something else. It's one of 12 products that they have at any given point in time. They've got 2 or 3 that are working well. And that's, if you're an advisor, that's all you hear about. Right. It's one thing if you're an institutional consultant and your whole job is to figure out what's going on in this stuff. Most of the people in the wealth management industry that I know are juggling a lot of different things. And so what they hear is they get these bombarded with incoming calls from people who who have a hot product, and no one calls and says, hey, we got lucky last year. We happen to have more short rates exposure than Man AHL. That's why we outperform them. It's always about, we built a better mousetrap, and that sailing of hot dots has meant that a lot of garbage has been sold into the wealth management community because there's a whole ecosystem around it. These are expensive products, which means you can pay your salespeople more. Which you do 12 of them, you've always got some. That's how you make a whole sales force effective. Morningstar's done some very good work on this, and they showed actually that chasing the hot dot in the liquid alt space destroyed more than every dollar of return people otherwise would have made. And so if we are successful, then it's going to be a lot around education and helping people to avoid these and identifying these landmines, because it's you don't find these things unless you're neck deep in it and have the time to do it. So here's one statistic that I tell people in the US, because they often say, look, that single manager thing is actually kind of easy. Right? If I'm running an RIA in the US and somebody says you want managed futures, and I just do a quick screen of the 5 or 6 largest funds, 5 of them have done much better than the index. But what the screen doesn't show me is that 40% of funds have been shot over the past 5 or 6 years. So there's this constant tension when we talk about democratization. It's also a hard sell to add things to your portfolio and mask the risks associated with it. And I think the managed future space in particular, I think part of the reason it's had this kind of it's got this, a lot of people have negative connotations in it because they feel burned.
Mm.
You know, they feel like they were sold these things that were supposed to be reliable and predictable, and nobody's showing them charts like this.
Yeah.
So what my hope is, and our target audience are guys who've adopted this model ethos.
Mm.
You know, if you want to the safest path between now and a happy retirement in 20 years is going to have a diversified portfolio where it's kind of intelligently constructed with these different offsetting pieces, and don't get out at the wrong time. Don't obsess over month-to-month variations of the underlying pieces. It's a holistic approach. And that's why, for me, managed futures is always best viewed in the context of that. It's what it does incrementally to the rest of a portfolio.
The rest of exactly.
Yeah.
Here's a quick question before we conclude this. You mentioned the commodities piece that was written in the late 90s, and subsequently, you know, the correlation is not zero.
Right.
What do you think is the chances that you know, here we've managed to bring managed futures out of the hedge fund space into single manager strategies, into mutual funds, into UCITS format? You've brought a fantastic replication product to the market. What is the chances that for the next 20 years, we see that CTA index, the index of managed futures, actually, you know, go the way of commodities with bigger drawdowns and poor alpha consistently?
I don't see it. First of all, one thing I always tell people to be cautious about with managed futures is they will be long sometimes. Right. I mean, in the port, you know, in kind of the risk measures that we look at, we were net short equities in the beginning of the year. We're net long now. Right. So I think the first time that I came to Europe to talk about a UCITS fund we were managing for a firm called SCI, it was in January and end of January 2018, and we were wrapping up the best month that we'd had in that fund, and it has a big managed futures component to it. And if you remember, in the end of 2017, equities went up pretty much every single day in the second half of the year, and you know, the managed futures, when they see that, that's a wave. That's a big monster wave, and they are riding it. And the longer it goes on, the more they like it, and the more they're convinced. There is, you know, if you're a fundamental investor, you watch them doing this, and you're like, guys, it's been going on for a long time. You really want to be adding risk in the fifth month of the run up in equities. And what happened is, by the time you got to the end of 2017, people were like, equities couldn't possibly go up anymore. And then they melted up in January. Right. And we were positioned for it. We made money. And so I was talking to allocators for the first time, and they said, "Oh, good, you know, you've got this big managed futures allocation, you're hedged." I'm like, hedged against what?
Yeah, exactly.
These guys, we have both skis pointed in the same direction, and we are in a tuck going downhill. And so, but you know, you've got to let the strategies do that, right? Because you can try to suppress these different ways of doing it, but so there will be periods of time, if the markets remain risk on for the next 4 or 5 months, these guys are going to dial into it.
Exactly. Yeah.
And so they are going to ride stuff out. You can't just, and if you want something where it does nothing, or you lose money every month until there's a crisis like last year, and you're willing to wait 9 years for that to happen, then there are other strategies you can do that. That's not managed futures, right? Managed futures is, you know, it's managed futures is not -5, -5, -5, -5 up 50. It's going to be, you know, it's going to be cash +3, cash +2, somewhere in like that over long periods of time, and then a big bump when you really, really need it. Yes.
Listen, Andrew, I think that's all we have time for. Before we go, I'd like to just kind of mention you manage a big and very successful ETF over in the US. And you've now brought that over to Europe. So there's now a UCITS vehicle available to investors. Just quickly, the name of the fund, and you know, how people can access it.
Yeah, so in the US, so they're both owned. So we're half owned by a firm called IM Global Partner that's based in Paris, London, and the US. And so they've actually launched both funds in the US. It's the IM DBI Managed Futures ETF strategy, and it's a similar name in Europe. It just launched a few weeks ago, but basically the idea was the managed futures ETF that we have in the US is now by far the largest managed futures ETF, although we are still such an infinitesimal portion of the overall market.
Yeah.
That my argument is that, as more people adopt the strategy, we've got plenty of room to go. But we had a lot of European investors who said, we really like what you're doing there. Can you bring it here? And so our partners really took the lead. They own the old Oyster CCAV in Luxembourg. And so they launched a fund, and some of our investors came in. So we're off and running. It's early stages, but it means you'll be seeing a lot of me in Europe this year.
Very good. Very good. Yeah. Looking forward to it. Right. With that, thank you everyone that joined the call, and look forward to speaking to you soon. Cheers.
Thank you so much. Great. Thank you, Ernst. Thank you, everyone. Bye.